Hello, and welcome to 6 weeks of Groundhog. My name is Elliot Foster, part of Team Emerald, and I'm pleased to be joined by Senior Analyst and Portfolio Manager Steve Russell and Analyst Ori Elon, who covers insurance for us. We're going to have a quick discussion on just the financial markets overall, banks, insurance. So let's just jump right into it. Ori, let's start with you. What are some of the recent trends that you have noticed in property casualty?
Yes, so in general, insurance companies performed exceptionally well in 2024 due to continued robust premium growth, better than expected underwriting margins as a result of improved expense structure and lower losses. In personal lines, insurers were able to push enough through successive rate hikes over the past 3 years, while inflationary pressures such as materials and labor costs subsided. While we observe some increase in competition, we believe that the industry is disciplined and has an interest in maintaining healthy ROEs, attractive combined ratios, and strong balance sheets with adequate reserve positions. In 2025, we expect rates to stabilize and even decrease in personal property lines, auto in particular, as carriers achieve adequate profitability and shift strategy to increase market share, focusing on premium in force and policy count growth. In commercial lines, we believe that the pace of rate increases has peaked. We expect rate trends to vary by insurance line, with some areas such as property, D&O, and cyber becoming more competitive. Other areas of casualty, such as general liability and commercial auto, should experience additional rate firming due to social inflation concerns, which could last for several additional quarters. We are keeping a close eye on any additional deterioration in prior years' reserve development in casualty lines.
Very good. Thank you. Just a follow-up to that, what are your main concerns then for the insurance carriers?
Yeah, so as kind of like outlined above, or said above, the biggest concern, especially for casualty insurers, is social inflation, or as the industry calls it, legal system abuse. Jurors across the country are hostile toward large corporations in general and insurance companies in particular. Jury awards in the past several years have increased materially, and nuclear verdicts are more prevalent today than at any other time. Plaintiffs are encouraged by attorneys and funded by third parties to sue and go to court. This issue poses a big risk to insurance companies who underestimated the eventual claims cost for policies that they had underwritten several years ago, and therefore have under-reserved for that exposure. As a result, we expect to see additional adverse development in several long-tailed casualty lines and for insurers to strengthen their balance sheets in order to meet higher obligations, but at the expense of earnings growth.
Very good. Thank you, Ori. Steve, let's pivot to you quick. Why is it springtime for banks right now?
Sure. So, banks were in recovery mode last year. We had concern around credit quality. You had lower earnings growth for the entire bank universe, really basically because you had slower growth in deposits, thus leading to slower loan growth. Net interest margins were being compressed. Well, we think through 2024, we've worked through that. We're seeing credit quality improvements. The fear of commercial real estate loans going bad, we think is in the rearview mirror for us now. You look at deposit growth is starting to come back to the banks now that we're seeing interest rates come down. And the banks are going to grow loans based off of the economy's outlook, but also based on deposit growth. You have to have the deposits to fund the loan growth. And we think all that's coming back into play. We're seeing loan growth return here in the first quarter of the year. Net interest margins for the fourth quarter of last year actually improved throughout the nation. So every region of the nation, with all the banks, we saw net interest margins improve. And that's the first time we've seen that in some time. And we think that continues through 2025. So we're excited about credit. We're excited about net interest margin growth, earnings growth, and tangible book value growth now that we're seeing the interest rates come down. And the three main things for bank stocks to work, it's really deposit growth, earnings growth, tangible book value growth. And we think we've got all that in place, along with good credit quality. So we're
Awesome.
really excited about what we see in 2025, and we think it goes through 2026 as well.
Awesome.
Yeah.
I know M&A has always been one of the themes that you kind of look to. And I think last year things kind of slowed down a little bit. Are you looking for M&A to reaccelerate?
Yeah, so M&A has been muted for some time, and we think we're going to see a resurgence in M&A. Excuse me. We're seeing pricing of deals improve, and those banks that they're acquirers actually have the multiples now. So multiples were depressed. The math didn't always work when you had to take the credit marks on the loan portfolios that were being acquired. And then there was also an issue with what we call adjusted other comprehensive income. A lot of words for saying the securities portfolios at banks had a lot of unrealized losses that hurt the math necessary to make deals work. And now that we've gotten beyond that, or we're getting beyond that, we think we're going to continue to see an increase in M&A activity here in 2025. Prior to the financial crisis, the pandemic, we had about 4% of the bank market would be taken out on an annualized basis through M&A activity. And we think we get back to those levels here in 2025. So
awesome. Thank you. Ori, let's pivot back to you. What area of the insurance market do you see the most upside?
So we see the biggest potential for upside in small cap E&S, excess and surplus insurers. The shift of business from the standard market to the E&S market is ongoing for many years now. As risk becomes more complex, insurance products are more specialized, new insurance needs emerge, and claim severity is rising. Also, the broadening of wholesale distribution is making risk placement easier and faster, which supports at least high single to low double-digit growth in the overall E&S market and mid to high teens growth for small cap insurers in this space. While the overall growth rate in this market is expected to slow from the torrid pace of successive rate increases for several years, quoting submissions growth remains elevated, and E&S insurers are increasingly comfortable with their underwriting returns and margins.
Steve, I think we have time just for one more question, and I think you just kind of touched on it. You just talked about share price performance and the three metrics that you look to: revenue growth, fully diluted earnings per share growth, tangible book value per share. Can you just maybe dig a little bit deeper into that, into what you meant by that?
Sure. Yeah. So all those things are the foundation to see multiples expand within our industry. And, we mentioned the fact that we expect that earnings growth this year. Last year, we could kind of see where the banks were restructuring their balance sheets, positioning things for that earnings growth. And we think now is the time where we start to actually see the banks fulfill that. We also think you're going to have revenue growth, net interest income growth. We're continuing to see higher yields as the loan portfolios reprice. So as things mature, the new loans are coming on at 2% higher than where the loan book is now. And we're seeing deposit costs come down. So we think that's going to drive that earnings growth, that revenue growth, and then tangible book value growth will follow behind that, especially now that we're beyond some of the marks that were hampering that growth through that adjusted other comprehensive income that I talked about before, which are just unrealized losses within securities portfolios for the banks. So we think it's a perfect storm. I really believe the industry as a whole will see good earnings growth, but I really believe the banks that we focus on, community banks, small regional banks, will outperform the larger banks because of that earnings growth generated through those loan portfolios.
Awesome. Thank you very much. And thank you, Ori, for your time. Thank you for joining us for our latest installment of 6 more weeks of Groundhog. Please go to our website at www.teamemerald.com if you want to see this and additional information from us. Have a great day.